Hello, everyone, and welcome to Gold Off the Charts. We bring you the sharpest financial insights every day, helping you cut through the noise to see the true nature of wealth. Today's video is one that many of you might be clicking on with a heavy heart. I know that last night was a long, sleepless night for countless precious metal investors, especially those who just jumped into the silver market. Just yesterday, the metals market staged a textbook flash crash. Crash, avalanche, stampede. These three words perfectly describe yesterday's market action. After hitting an all-time high of $84, silver suddenly faced a guillotine sell-off without any warning. It plummeted over 9% in a single day, at one point diving below $71. Let that sink in. If you were using 10x leverage, your entire account was wiped out last night. In trading circles, we call that graduating, and not in a good way. Meanwhile, gold wasn't spared either, posting its biggest one-day drop since late October as prices neared the $4,300 mark. Now the market is in pain, and panic is spreading like wildfire. Everyone is asking the same thing. Is the bull market dead? Am I trapped at the top? Is there any hope left? There's even a terrifying rumor that started circulating yesterday afternoon that will give you chills. Word on the street is that a systemically important bank was forced to liquidate because of a massive silver short, and the losses are astronomical. Today's video is crucial. This isn't just a recap, it's a survival guide. We need to figure out three things. First, who really caused yesterday's bloodbath? Second, how much truth is there to the rumors about bank liquidations and a Fed bailout? Third, and most importantly, is the bull market case for precious metals still intact after this crash? Is this your exit signal or the last chance God gives you to buy the dip? Please take a deep breath and stay calm. Let's step into the eye of the storm together. First, I want to say something that might be hard to hear. If you're a loyal viewer of Gold Off the Charts, and you paid close attention to my Christmas robbery video on December 24th, then yesterday's crash shouldn't have shocked you. You might even be unscathed, or better yet, sitting on profits from a well-timed short. In that video, we flagged a major risk: liquidity drain during the holidays. We explained that when trading volume is thin, prices get wild and what goes up fast usually comes down even faster. So, this sudden plunge was actually several risk factors we've already discussed, hitting at the same time and place a perfect resonance. Let's break down exactly what caused this massacre. The first blow came from the CME's cooling order. As I warned in my last video, the CME hiking margin requirements is a massive red flag. The exchange doesn't do this for fun. This is their way of aggressively cooling down overheated speculation. Yesterday, as those new margin rules kicked in, tons of traders who couldn't cover the extra costs were forced to close out. They didn't want to sell, they had to. This is a classic long squeeze or bull stampede. The second blow was the lack of liquidity. Remember what I said? During Christmas, Wall Street traders are away and the market is like a bathtub with the plug pulled out. When silver started wobbling at the highs yesterday and the first big sell order hit, there weren't enough buyers to catch it. Normally, it might take a $1 billion sell order to move the price 1%. But right now, it might only take $100 million to make it dive 3% because the market makers are on vacation. Consequently, the price sliced through stop-loss levels, triggering a massive chain reaction. This is why the drop was so violent. It happened so fast that people didn't even have time to set their stop losses. The third blow involves the fear surrounding the bcom index. Remember the January 8th date I mentioned? The Bloomberg Commodity Index is about to do its annual rebalancing. According to JP Morgan, because silver has outperformed so much over the last 3 years, passive funds are forced to dump about 9% of their total futures holdings. That is a massive, predictable wall of selling pressure. The market is forward-looking and tries to front-run these events. Since everyone knows the big guys have to sell in January, why would the bulls wait? As a result, smart money decided to take their profits early at year-end. This rush for the exit is exactly what detonated the market yesterday. These three factors, margin hikes, thin liquidity, and index rebalancing fears, stacked on top of each other to create yesterday's perfect storm. While the technicals explain the price drop, the following news explains the pure panic we're seeing. Since yesterday, a message has been flying through Wall Street trader groups. It's not officially confirmed, but it's haunting the market and suffocating every investor. The rumor is that a global megabank blew up when silver hit $84 because they were holding a massive short position. The details being whispered are incredibly specific. They say the bank missed a margin call worth $23 billion and was facing total liquidation. To prevent another Lehman Brothers moment, The Fed supposedly had to inject $340 billion to stabilize things. Guys, a $23 billion margin gap is insane. That would mean their short position was in the hundreds of billions. If this is true, then yesterday's silver crash wasn't just bulls taking profits, it might have been a coordinated hunt. Think about it. If a major bank is on the verge of collapsing, what would they do? They would use every resource to crash the price in both the spot and futures markets to save themselves. While this is just a rumor for now, with no official word. In the world of finance, rumors are often just news that's ahead of schedule. The mere whisper of this was enough to shatter the market's nerves and turn panic into a frenzy. This confirms what I always say. The silver market is incredibly deep and dangerous. It's not just about supply and demand. There are sharks fighting beneath the surface that we can't see. Okay, the post-mortem of last night is done. Now, you're probably asking, with liquidation risks and index selling ahead, is it over for precious metals? Is the bull market dead? My answer is no. This is a violent reality check for an overheated market, but it's definitely not a total trend reversal. I have 3 core reasons to back this up. First, the technical history. Yes, falling 8% is scary. But if you look at the chart, the price has just retreated to where it was a few days ago. We haven't even broken the main trend line. I actually went back and checked the historical data for you. In past silver bull markets, there have been 6 times where the price dropped more than 6% from a 1-year high. The result? In all 6 cases, silver bounced back within a week and recovered the entire loss. This shows us that sharp drops in a bull market are often just shakeouts by the big players to catch people off guard, not the end of the trend. Second, the underlying money flow. If you look at the whole year, precious metals have actually outperformed the S&P 500. What is Wall Street actually scared of right now? It's the AI bubble popping. With tech stocks at sky-high valuations, smart money is looking for a hedge. Precious metals are now seen as the ultimate insurance against a tech wreck. This is a massive, long-term shift of capital, moving from overvalued paper assets into undervalued physical assets. That trend doesn't change because of one bad day. Third, and most importantly, is the new narrative: commodity control. This is a very interesting concept Goldman Sachs recently introduced. In the past, people bought gold and silver because of Fed rate cuts or inflation. But now, the market is pricing in a different logic. Goldman believes metals are now strategic assets, not just cyclical ones. In today's world of anti-globalization and trade wars, who controls the supply of copper, silver, and rare earths? Whoever controls those resources controls the future. This national security premium is being baked into the price. This is a long-term structural repricing. As long as the geopolitical great game continues and supply chains are a priority, the foundation of the metals bull market is rock solid. Let's summarize. Yesterday's crash was a perfect storm of factors hitting at once. It was a violent correction of a move that was too fast and too speculative. Holiday liquidity just acted as a megaphone for the drop. But always remember, a real bull market isn't a straight line. It's full of violent shakes meant to scare you out. For us regular investors, what's the move? If you're still holding at high prices, check your margin to make sure you aren't liquidated. If you graduated, lost it all. Step away for a while, clear your head, and don't try to revenge trade. Wait for the setup. For those with cash on the sidelines, this crash is a gift. But don't catch a falling knife. Wait for the volatility to settle down a bit. Wait for that January 8th selling pressure to pass. That might be the perfect time to build a position. Look at the big picture. Don't let daily swings scare you. The long-term case for metals, the decline of the dollar's credibility, the fight for resource control, and the physical supply gap, none of those drivers have changed. Finally, I must emphasize again, this analysis is just my personal observation and logical deduction. It is not investment advice. Trading is your responsibility. Please make your own decisions based on your own risk appetite. In this high-stakes game of wealth, your mindset matters more than your math. This is Gold Off the Charts. If you found this emergency update helpful, please like, subscribe, and hit that notification bell. Let's find the truth in the volatility and the opportunity in the crisis. See you in the next video.